Unveiling the dynamics. The impact of interest rate changes on the valuation of fixed income securities. In the realm of financial markets, the delicate dance of interest rates casts a profound shadow over the valuation of fixed income securities. Understanding how changes in interest rates can ripple through various types of fixed income instruments is essential for investors seeking to navigate the nuanced landscape of bond markets. This exploration delves into the intricate relationships between interest rates and the valuation of different fixed income securities, shedding light on the dynamics that shape investment decisions. Government bonds and the yield curve. Government bonds, often considered the bedrock of fixed income markets, are particularly sensitive to changes in interest rates. As interest rates rise, the prices of existing government bonds tend to fall, creating a seesaw effect with yields. This inverse relationship is eloquently illustrated by the yield curve, a graphical representation of yields across different maturities. Consider a scenario where interest rates are on the ascent. The yields on newly issued government bonds reflect these higher rates, making existing bonds with lower yields less attractive to investors. Consequently, the prices of these previously issued bonds decrease to align with the prevailing market yield, exemplifying the interest rate risk borne by bondholders. Conversely, in a declining interest rate environment, the prices of existing government bonds may rise as investors seek higher-yielding options in a market where new issuances offer lower rates. The yield curve, in this context, can exhibit a downward slope, showcasing the inverse relationship between interest rates and bond prices. Corporate bonds and credit spreads. Corporate bonds, unlike their government counterparts, encompass an additional layer of complexity tied to credit risk. Changes in interest rates can intertwine with shifts in investor sentiment regarding a company's creditworthiness, amplifying the impact on corporate bond valuations. In a rising interest rate environment, corporate bonds may face a dual challenge. Not only do they contend with the downward pressure on prices associated with higher rates, but they also confront the potential widening of credit spreads. As investors demand higher compensation for assuming credit risk, the spread between corporate bond yields and government bond yields expands, adding to the downward pressure on corporate bond prices. Conversely, falling interest rates can offer a reprieve for corporate bonds. As market participants embrace riskier assets in pursuit of yield, credit spreads may tighten, mitigating some of the downward pressure on prices. Investors, in this environment, may find solace in the potential for capital appreciation as bond prices rise in response to declining interest rates. Municipal bonds and tax considerations. Municipal bonds, issued by state and local governments, occupy a unique space in the fixed income universe due to their tax advantages. The impact of interest rate changes on municipal bond valuations intertwines with investors' considerations of after-tax returns. In a rising interest rate environment, municipal bond prices may experience downward pressure, aligning with the broader trend in fixed income markets. However, the after-tax yield of municipal bonds could still present an attractive proposition for investors in higher tax brackets. The tax-exempt nature of municipal bond interest income becomes particularly appealing when compared to taxable alternatives. Conversely, falling interest rates may enhance the appeal of municipal bonds. As interest income becomes relatively scarcer in a low-rate environment, investors may turn to tax-advantaged options, such as municipal bonds, to bolster after-tax returns. The interplay between interest rates, tax considerations, and municipal bond valuations underscores the multifaceted nature of fixed income investing. Mortgage-backed securities and prepayment risk. Mortgage-backed securities, MBS, add an additional layer of complexity to the fixed income landscape due to the presence of prepayment risk. Changes in interest rates can trigger shifts in prepayment behavior, influencing the valuation dynamics of MBS. In a rising interest rate environment, homeowners may be less inclined to refinance their mortgages, reducing prepayment risk for MBS investors. However, the prices of existing MBS may still experience downward pressure as yields on new issuances reflect higher interest rates. Investors in MBS must navigate this interplay between reduced prepayment risk and the broader impact of rising interest rates on bond prices. Conversely, falling interest rates can heighten prepayment risk as homeowners seize the opportunity to refinance at lower rates. While MBS prices may rise due to the increased demand for higher-yielding fixed-income assets, investors must contend with the potential for accelerated principal repayments, impacting the effective duration of their MBS portfolios. Conclusion. In the intricate tapestry of fixed-income markets, the valuation of different securities undergoes a delicate ballet in response to changes in interest rates. From government bonds and corporate debt to municipal securities and mortgage-backed instruments, each category of fixed-income security presents a unique set of challenges and opportunities influenced by the ebb and flow of interest rates. Investors navigating this landscape must possess a nuanced understanding of the interplay between interest rates and the specific characteristics of each fixed-income instrument. By grasping the intricacies of these relationships, market participants can craft resilient strategies that harness the potential for capital appreciation while mitigating the risks inherent in the ever-changing environment of fixed-income investing.